Spot says one thing while real buyers in May's silver delivery attention pulls viewers toward real-world premium explanations are already paying something else. That mismatch is where the useful signal hides, because the quoted price and the physical bid are not telling the same story. This setup matters because two silver prices before May, $91 Dubai versus $73 COMEX explained, is not just a headline story, it can change the math for two faster than most holders expect. Stay with me, because the key signal is not the loudest one, it is the one that changes what happens next. By the end of this video, you'll know exactly which signal matters most and what it means for your next move, and I'll translate it into what it means for a real stacker, not just another macro recap. The fast answer is that both prices are real, but they describe different things. Here's what this means. If you're stacking silver right now, the quoted futures and wholesale benchmark price tells you where paper exposure and large reference contracts are trading for your physical metals position. This changes the math entirely. The physical price in a regional market tells you what a real buyer may have to pay to get actual metal into hand, in that location, in that product form, on that timetable. When those two stop moving together, the gap is not just trivia, it is a signal that replacement cost is drifting away from the comfort of the spot screen. That is why a Dubai number near $91 against a COMEX style reference near $73 gets attention. It suggests the market for immediate physical ounces is speaking more loudly than the benchmark headline, especially with May delivery chatter pulling more eyes into silver. What makes this important is not the existence of a premium by itself. Physical silver always carries some premium over spot because somebody has to refine it, ship it, finance it, distribute it, and sell it. The problem starts when the premium is no longer acting like a normal retail markup and starts acting like a stress signal. That is when you see a regional market pay materially more for bars and coins, while the benchmark still looks almost polite. In that situation, the investor who thinks silver is still a $73 story may discover the real buy now price is a very different number. That difference can come from several layers at once. First, local buyers are not purchasing a chart. They are purchasing bars available now in a certain size with a certain chain of custody from a certain inventory pool. Second, a regional market like Dubai can tighten faster because local wholesale demand, trade flows, import frictions, fabrication demand, and nearby investor interest all hit the same visible inventory at once. Third, when a delivery month starts drawing attention, sellers often become less generous even before there is a dramatic headline. They protect inventory, widen spreads, and make replacement costs the number that really matters. If this kind of breakdown helps you see why the dealer screen and the market screen can feel like two different worlds, hit like, because this is exactly where a lot of stackers get caught off guard. The first proof beat is simple. A wide regional premium is telling you more about urgency than the benchmark is. If Dubai silver is effectively pricing near $91, while COMEX reference is closer to $73, that is not a rounding error. That is an $18 difference per ounce. For a real stacker, the meaning is immediate. A 10-ounce purchase is not separated by a tiny fee. It is separated by about $180 before you even add dealer margin, shipping, or local taxes. A 20-ounce buy is about $360 apart. A 100-ounce bar is about $1,800 apart. So when someone says silver is still only $73, the correct follow-up is where, in what form. That is also why the phrase two-price problem lands so hard with physical buyers. One price is a benchmark reference. The other is the price that punishes delay. If your goal is not to trade a contract but to secure ounces, the second number can become the only one that matters. And once that happens, waiting for the benchmark to confirm the move can leave you paying the higher price anyway, just later and with fewer product choices. Now let us get to the second proof beat, because this is where the May angle matters. Delivery attention changes behavior even before the market gives you a cinematic shortage headline. Traders watch contract months more closely. Dealers monitor wholesale refill costs more aggressively. Wholesalers become less eager to part with desirable bars if they think replacement is getting harder. None of that requires the market to be out of silver everywhere. It only requires enough uncertainty that the people closest to physical metal start charging for inconvenience, time, and risk. For the stacker at home, that means product-specific tightness can show up before a dramatic chart breakout. 1-ounce coins may develop a different premium from kilo bars. 10-ounce bars may disappear from the cheapest listings first. Large bars may remain available, but only at a number that makes the headline spot quote feel fictional. This is why experienced buyers stop asking only whether silver is up or down and start asking which form is tightening, in which region, and how fast the refill price is changing. Here is the midpoint turn that matters most. The real damage is often done before the broad market finally notices. By the time the average headline says silver is moving, the stacker who actually needed to buy may already have paid the real move through premium expansion, slower availability, or forced substitution into less efficient products. In other words, the first cost is not always a chart breakout. Sometimes it is the quiet loss of buying quality. That is what a regional premium is really exposing. It is not just saying silver is more expensive in one place. It is saying the path from benchmark price to delivered metal is under strain. And if you are building a position into May, the path matters more than the theory. It does not help to tell yourself silver is $73 if every realistic route to acquiring recognizable physical ounces in your market looks much closer to the higher number. This is where a lot of people make the wrong comparison. They compare spot to spot or futures to futures and assume the physical gap will normalize on its own. Sometimes it does. But if the local premium is being driven by genuine replacement stress, normalizing can happen in two very different ways. Either the regional premium comes down because supply loosens, or the benchmark comes up because it finally catches the pressure the physical market was already signaling. If you are the buyer who still needs ounces, both outcomes can leave you paying more than you expected if you waited for certainty. So what should a real holder or stacker take from this right now? Start with replacement cost, not portfolio vanity. If you already own 25 ounces and you are looking at a benchmark chart near $73, it is tempting to think your stack is worth roughly $1,825. But if replacing the same 25 ounces in your actual market requires something closer to the Dubai-style stress price, now you are thinking about roughly $2,275 before the usual frictions. That is a $450 reality check. For 50 ounces, the gap is about $900. For 100 ounces, it is about $1,800. The point is not to invent panic. The point is to stop valuing a physical plan with a paper-only lens. And if you are still buying, this becomes even more concrete. Say your target for April was 2 10-ounce bars. At a calm benchmark mindset, you may have budgeted around $1,460 using the lower quote. At the higher physical market reality, you are closer to $1,820 before normal retail extras. That difference can determine whether you finish your planned buy, step down in size, or get pushed into higher premium 1-ounce pieces because the bars you wanted are gone. That is why the timing around May matters. Once attention concentrates on delivery, the market does not need to be globally broken for your purchase plan to become noticeably more expensive. Tell me in the comments what you are actually seeing where you buy. Wider premiums, slower shipping, missing bar sizes, or no real change yet. The useful signal in this market is often what buyers can really get, not what the cleanest chart says. There is another important piece here, and it helps keep this analysis grounded. A two-price silver market does not automatically mean some apocalyptic collapse is happening tomorrow. Sometimes it simply means the physical market is more honest about scarcity, logistics, and immediacy than the benchmark is in that moment. That distinction matters because it keeps you from swinging between denial and sensationalism. You do not need a dramatic end-of-system story to understand why a regional $18 spread per ounce is significant. You only need to understand that the person buying metal today is paying for the frictions the benchmark abstracts away. That is also why institutional names and benchmark acronyms matter less than many people think once the spread opens. LBMA and COMEX still matter because they anchor global reference pricing and trader attention. But the real-world decision for a stacker is not which acronym wins an argument. The decision is whether the next ounce can be bought at a reasonable cost in a preferred product before premiums widen further. When the regional market starts charging well above the benchmark, it is effectively voting on immediacy, and immediacy tends to get more expensive when a delivery window starts attracting attention. At this point, the practical play is not complicated. Watch product-specific premiums, not just spot. Watch whether dealers are swapping featured items more often because inventory turns are getting awkward. Watch whether larger bars stay available while fractional or retail-friendly products tighten first. Watch whether the premium gap narrows because supply really improves, or whether it narrows because the benchmark rises and meets the physical market part way. Every one of those clues tells you more about your next purchase than a clean chart by itself. This is also the credibility peak for the whole argument. If the benchmark stays calm but your replacement cost keeps rising, the benchmark is no longer your decision price. If you want more breakdowns that focus on actual buying conditions instead of just the headline quote, subscribe, because this part of the market is where timing mistakes usually happen. Now let us close the tension from the opening. Which silver price is real before May? The $73 COMEX style quote or the $91 Dubai style physical quote? The honest answer is both, but they answer different questions. The lower number tells you where the benchmark is. The higher number tells you what urgency, local demand, and immediate physical access are already doing to real acquisition cost. If you are trading exposure, the benchmark may be enough. If you are stacking metal, the regional physical number is often the one that can hurt you first. So the takeaway is not simply that silver is expensive in one place. The takeaway is that a market can look calm on the surface while replacement cost is already moving underneath it. That is the real meaning of a two-price silver problem. And with May delivery attention pulling more people toward physical explanations, the window that matters is not when the last skeptic agrees. It is when your preferred ounces are still available at a price you can live with. One last practical layer matters here, especially if 2 is not a trading chip to you but a serious position. The market does not need to hand you perfect certainty for this window to matter. It only needs to change how it prices the path into May silver delivery. Attention pulls viewers toward real-world premium explanations. That is why discipline beats prediction in a setup like this. If the move comes fast, you need to know what a real win looks like for 2. If the move stalls, you need to know whether you are looking at noise or a real failure of the catalyst chain. For a real stacker, the question is not whether the headline sounds exciting. The question is whether it changes the price, access, or replacement cost of real ounces in a way you would actually feel. The useful signal is not the first candle after May. Silver delivery attention pulls viewers toward real-world premium explanations. It is whether the market starts treating this setup as more believable a few days later. Put plain numbers on it. If 2 gains $1 more of value than the market expected, that difference is no longer abstract. It changes what patience, conviction, and risk actually feel like in your own account. And if the catalyst underdelivers, the same bag tells you very quickly whether you are positioned for a real refing or only for a loud headline. That is why the next question after May silver delivery attention pulls viewers toward real-world premium explanations is never just what price printed first. It is whether the next week makes the same move look more believable or less believable. Now translate that into buying behavior, because that is where the metals story gets real. If premiums, delivery pressure, or replacement cost keep drifting higher into May silver delivery attention pulls viewers toward real-world premium explanations, The stacker who waited for a cleaner headline may discover the easy inventory is already gone. That is why a 20-ounce top-up, 100-ounce bar, or a larger staged buy can feel very different depending on whether the regional market is calming down or quietly tightening. The chart can stay polite while the real purchase gets harder. For a physical buyer, that gap between quoted price and replacement price is often the whole trade. There is a second layer here that matters just as much as the premium itself: how fast inventory can be replaced once a dealer sells through what they already have. If the next bar, coin, or wholesale lot has to be sourced in a tighter lane, the premium does not have to explode to change behavior. It only has to stay elevated long enough to make every delayed buy less flexible. That is why stackers who understand timing risk often split purchases before May. Silver delivery attention pulls viewers toward real-world premium explanations, instead of assuming the quote on the screen will still be waiting for them later. One more grounded way to think about it is this: the physical market does not need a dramatic shortage headline to punish hesitancy if opened with that contradiction. The answer is now clear for precious metals holders: attention. It only needs a few weeks where replacement cost, regional demand, and dealer caution all lean the same direction. Once that happens, the stacker who was budgeting off yesterday's cleaner benchmark starts paying tomorrow's tighter real-world price. That is the practical lesson behind every premium story like this one. That matters because a real stacker feels May silver delivery attention pulls viewers toward real-world premium explanations through replacement cost, not through a neat chart label. If 2 is part of a long-term plan, timing pressure shows up when dealers, wholesalers, and regional buyers all start leaning the same way. The quoted price can stay polite while the actual buying decision gets harder, more expensive, and less flexible week by week. That is why the contradiction between the paper quote and the physical bid matters more than one dramatic headline about shortage or relief. For a real stacker, May silver delivery attention pulls viewers toward real-world premium explanations matters only if it changes what ounces cost, how fast physical pressure is building, and whether waiting gets more expensive. If you hold 2, that is the part worth watching. A real stacker should leave knowing where the premium is widening, what ounces really cost, and whether waiting is getting more expensive. If this helped you see the difference between a benchmark quote and a real-world silver buy, hit like, subscribe for more physical market breakdowns built around actual acquisition conditions, not just macro headlines, and comment with the premium, delay, or product shortage you are seeing in your own market right now.